Hi, my name is Alex Dolphin and welcome back to another episode of Assn. Today we're going to discuss the case of U.S. Bank versus Ibanez. This case was heard in the Supreme Judicial Court of Massachusetts in the year of 2010. Let's go ahead and jump into the facts of the case. So this case discusses two separate mortgagors, the Ibanez family and the Larace family. Both families had purchased homes through mortgages. The home was maybe $150,000. Maybe they had $30,000 for a down payment. They got a mortgage for $120,000. So they got that mortgage from two separate companies. It doesn't really matter the names as much, but they got them from two separate companies that originated their mortgage, right? So that mortgage came from those companies. Both families subsequently paid on the mortgage for a period of time. While that was going on, the original mortgagee, so the person who had lent them the money, transferred the mortgage to other entities, right? So on both sides, there had been a transfer of the lender's interest in the mortgage to different entities. So with the Ibanez's, it had gone through a couple of different aspects. It had gone to Lehman Brothers, and then eventually it had gone to U.S. Bank as a trustee, right? And with the Larace's, had gone through the docket, and then eventually Wells Fargo ended up holding their interest, so the lending interest on that side of the mortgage, if that makes sense. So you have these two mortgagors who subsequently default on their mortgage. They can't pay their mortgage payments anymore. Both of the institutions that held their mortgage, at least believed that they held their mortgage, then went ahead and tried to foreclose upon the homes. So U.S. Bank and Wells Fargo both tried to foreclose upon the respective homes. U.S. Bank on the Ibanez's, Wells Fargo on the Larace's. So they try to foreclose. They force a sale. They buy the home themselves because they're the trustee of the mortgage, and they think that they have the homes. Well, both families challenge this, and they say that, Wells Fargo, U.S. Bank, you didn't have the ability to foreclose upon the home because you didn't actually have the mortgage assigned to you from the prior lender. So in both instances, the prior lender hadn't assigned the mortgage to the foreclosing entity until the homes had actually been foreclosed upon. So what the argument that the individual homeowners are making is that, hey, you didn't have the right to foreclose upon my home because the mortgage itself hadn't actually been assigned to you prior to the foreclosure. It was only after the foreclosure that the mortgage had been assigned to you. So the court is left to consider, are we going to enforce this law to the letter, or are we going to take it for its reason, right? If you're going to enforce the law for the letter, you would say that, well, they didn't actually have the title to the mortgage or to the home, right? Because it was never assigned to them. If you're going to look for the reason of the rule, you might argue that, that rule is just to make sure that the entities that should be foreclosing are foreclosing. In essence, both of these entities did have the mortgage. There was just some missing paperwork, so they should be able to foreclose. The court ultimately comes down on a black letter interpretation of the law and says that because both foreclosing entities didn't actually have the mortgage assigned to them prior to the foreclosure, they didn't have the right to foreclose the home, and they didn't have title in fee simple. So they come on behalf of the mortgagors, the individual homeowners, and they ruled against the banks. So that's the case. The rule is that if an entity is going to foreclose upon a home, the mortgage actually needs to be legally assigned to them before they do it. The court says that deed doesn't need to be recorded, although it would be nice if it was, but it does definitely need to be assigned, and there needs to be a clear paper trail if mortgages are transferred between entities that it can actually be tracked and the assignment can be proven via paper trail. So that's the case. An ex-ante discussion of this is that this process that the court is grappling with here is essentially what led to the demise of the mortgage industry, right? Because it's mortgage pooling. These large entities would buy up thousands of mortgages, so Wells Fargo, U.S. Bank, from investment banks. They would buy up thousands of mortgages, and then they would just, say some are going to default, some aren't. But if they default, we'll just foreclose on the homes. So this type of behavior by the investment banks of pooling securities and transferring mortgages from one person, one entity to another served to increase the profitability of these banks. But some people would say that was at the expense of the individual mortgagors because they didn't really know who held their mortgage. they were going to be more likely to get bad mortgages, right, and get lent subprime loans because the mortgagee could just transfer their interest from person to person to person. Ultimately, this court's ruling does come down on the side of the mortgagor and rules in favor of property rights and families owning homes rather than these institutions transferring mortgages to one another. So that's interesting. I think that there's an argument to be made against de-incentivizing large institutions from pooling and moving mortgages, right? The 2008 financial crisis was really bad, and I think we can all agree to that. But this type of behavior by investment banks and other banks does have the purpose of increasing mortgages into the market, increasing the amount of people that are able to own homes through mortgages, right? So I don't know if we want to consider that to be a bad thing. You know, maybe we should let people try and buy homes, and if they default, then they default. But what the court ruled in this case does have a small disincentive for big banks, for investment banks to actually pool securities and transfer them one to another because of the difficulty that it takes to keep that clean paper trail when mortgages are assigned and sold to other institutions via securities. So thanks so much for watching. I hope you enjoyed this video. If you'd like to see more, go ahead and hit that subscribe button, and I hope you have a nice rest of your day. Bye-bye.